How is tax working in 2026-2027? Let's have a look at how it fits together with some dividend planning. Hi, I'm Kimberly Shapcott, qualified chartered accountant, property investor and entrepreneur. Let's sit down and have a chat. We're now at the beginning of our 2026-2027 tax year, which is fabulous. New tax year, new limits, new tax rates, unfortunately. So let's have a look at how the changes in the dividend tax are going to be working so that we can see what the impact is going to be on our income for this tax year. Let's dive into some examples straight away so that you can see exactly how it's fitting together as you start taking your income from your companies over the next 12 months and you don't get any shocks or surprises next year when you are starting to prepare your tax return.
Our first example today is a basic rate taxpayer example to give us an idea of how the tax will fit together. So in our example, we are going to have a salary of $12,570, which, as you may be aware of, is our current personal allowance. This is done as salary, so it maximises out of any business, the corporation tax rate saving, and it also helps maximise what you are getting as employment income to ensure you're getting your national insurance stamps and also any statutory benefits. In addition to this, we've got our rental income because we are a property tax channel. So we've got our rental income of $15,000, some mortgage interest of $5,000, and our repairs and expenses for the rental property, which gives us rents of $15,000, mortgage interest of $5,000, and expenses of $2,000. So our rental profits are going to be $13,000, and when we come to look at the finance costs, we'll be using our $5,000. And in our example today, we are using $20,000 as our dividends. Now, when we look down at what our total income is for tax purposes, it is showing our income is at $45,000. Now, this means that theoretically, to make full use of your basic rate tax band, you have got another $5,000. So the dividends could go up by another $5,000 to take us to $50,570, which would just take us over the $50,270. So you can play with your dividends depending on how much income you have in your business, how much you have available to vote as dividends. The key thing there is you must have profits after tax and have the reserves to vote dividends. But then you can decide exactly what dividends you want to take, whether you're limited by what you can take out your company or whether you're limited by what tax you want to be paying as an individual. In terms of how we calculate the tax for this example, we've got our $12,570 personal allowance, which is used by the salary. We then have our $13,000, which is taxed at 20% in our 2026-2027 tax year at $2,600, because we've got our $13,000, which is the $15,000 rents, take off the expenses to give us our $13,000 rental profits, which we are going to be taxed on. Now, on top of this, then we are going on to how our dividends get taxed, and we still have our $500 at 0%, which means we've got £500 that we're not paying any tax on to increase the $12,570 to $13,070 that we get tax free. Now, the rest of our dividends up to the higher rate band, up to the $50,270, are going to be at our new dividend tax rate, which is our 10.75%. So it's not a big increase. As we can see, it's a small 2% increase. However, it is an increase. So on that basis, we've got a $19,500, which is now left to be taxed at 10.75%. which gives us tax of $2,096.25. This gives us a total tax charge on our $45,570 of £4,696.25. But before we get all sad and wonder, oh God, how am I going to have to pay this tax bill? Just wait a minute, because we can take some more off, because we've not dealt with our finance costs side of things just yet. So with our finance costs, which we can see on our screen towards the bottom left hand side, we need to look at the lower of three different numbers, one being the finance costs, the next being our property profits, and the other being our adjusted total profits. So on that basis, our figures we are working with is our 5,000, our 13,000 and our 45,570. So on that basis, the lowest of those is our finance costs, which means we can now put our finance costs into our calculation. And our finance costs then get a 20% tax reducer or allowance. So 20% of our 5,000 is 1,000. So from our £4,696.25, we take off 1,000 to give us our final tax liability, which is £3,696.25 to be specific, but £3,696 tax that we will need to be paying. So in terms of our net disposable income, we're now looking at a figure of, our net disposable income is therefore 41,874, which is going to be lower than you will have received in a previous tax year with the same amount of gross income because of this increase in the 2% on dividend tax. Obviously, it's not a big amount of money, so it's not going to be in the thousands, but it is a couple of hundred, potentially different to what you'll have received in the past, which does mean you may want to be considering whether you need to be increasing your dividends to enable you to retain the same net disposable income as you were before. For example, on our example, you could increase by an additional up to just under 5,000 to get you to a slightly higher total income, and hopefully that with the additional tax would then look to keep your net disposable income the same. Obviously, this will still be dependent on whether there is profits available in your company to enable those dividends to be voted. But I know I see a few people who are wanting to stick with this sort of level so that they're mitigating any taxes that they're paying personally. Obviously, we can look at going higher, so increase your income and going into the high rates of tax. So we're going to jump into our next example, which is our higher rate taxpayer, to see how that fits together and what sort of things we need to be considering as we're increasing our income to ensure that we're not suddenly finding we're actually in a worse off position. Moving on to our higher rate tax calculation then, and what we need to consider when we are looking at that. We've kept our salary at our 12,570, which is the personal allowance at present, and our rents have gone up slightly because we've got a slightly different property in this example of 18,000, and our mortgage interest is 7.5, and our repairs and expenses are 2,000. So our total income is going to be our gross salary of 12,570. We've thrown dividends into the mix at 50,000. We've got our rents at 18 and our expenses of 2 to give us total income here of 78,570. So let's dive straight into our calculation to see how the tax is fitting together, and then we can chat through the bits where you need to have a think as you're doing different things in the tax year of what the impact of any additional income is going to be. So our tax calculation on the right hand side of the screen is our personal allowance of 12,570, which is being used by our salary. We then have our rental income, which is taxed, which is our 18,000 less those expenses of 2,000 to give us 16,000, and that's taxed at 20%. So that's giving us 3,200 in our 26-27 tax year. The final thing that we need to do our tax calculation on is our dividend income. Now, as you can see, our first 500 is still at 0%, and we've still got that little bit that we don't have to pay any tax on. We then use the remaining part of our basic tax allowances, which is 37,700, at 10.75%. So we've used some of that 37,700 for our rental income, the 16. So in this example, we've got 21,200 at our 10.75%, which is giving us a tax payable of 2,279. Now, The rest of the dividend income that has not been taxed now, which is at $28,300, will now be taxed at a 35.75% tax rate, which is 2% higher than it was before. So this gives us a tax charge of £10,117.25. Now, this is the bit where if you want to increase your dividends, this is where the additional tax charge will be. So if instead of 50,000 you wanted to add another 20,000 to take you up to 98,000 total income, then this would then give you the additional 20,000 at 35.75%. So this is where if you're taking anything extra when you are at the high rate tax threshold, you just need to be taking account of if you take 10,000, 3,575 of that will be taxed. The rest of it is arguably your net disposable income. If you need 10,000 as your net income, you need to equate it back up to the total value with the tax to see how much income you need after tax to give you the 10,000 net figure. So it's just something to be aware of so that you know what tax you are going to pay on whatever income you are taking. Now, obviously, this is all very dependent on your companies, and your companies have to be generating enough profits to be enabling you to take those profits. So this is profit after tax that you'll be able to draw as dividends, and then you will be taxed personally on those dividends that you are taking. Now, just because we've got to tax of $15,596.25, having added all those up together, we have got one additional adjustment that we need to take into account, which is our finance costs. Now, our finance costs are going to be the lower of the finance cost, the property profits, or the adjusted total profits. So hopefully you can see on screen in the bottom left-hand corner, we have $7,500 finance costs, we have 16,000 property profits, and we have 78,570 adjusted total profit, which therefore means that the lowest of those is going to be our finance costs of 7,500. Now, the tax reducer, or the allowance that we can claim for the finance cost, is 20% of our finance costs. This does not matter if you're a high rate taxpayer, additional rate taxpayer, a basic rate taxpayer. It is always 20%. So 7,500 times 20% is 1,500. So our 15,596.25 has 1,500 taken off to give us a total of 14,096, which is our tax payable on our 78,500 income. So this in effect gives us a net disposable income of 64,474, or around the 64,500 mark. So it's not too bad an amount of tax to be paying for that income. However, it is slightly lower net disposable income, slightly higher tax, with the additional 2% on those dividends. Now, as you do increase, the bit that you need to be aware of, having gone from the basic rate tax band up to the high rate tax band and going from 10.75% dividend tax to 35.75% dividend tax, the next threshold that we need to be aware of is the 100,000 mark, because at the 100,000 mark, we start to lose our personal allowance. So the 12,500, the 12,570 that we currently have with no tax, that starts to disappear at 100,000. And for every £2 you go up, you lose £1 of your personal allowance. So by the time you get to 125,000, you'll be taxed on the whole amount of your income. There will be no tax-free element apart from your £500 at 0% on your dividend tax. So this means if you are wanting to go to that level, it is something to be aware of, because then when you hit the 125,000, you are now into the high rates of tax, or the additional tax rate, which then goes up another proportion, which is closer to the 40% tax for dividends. That is at 39.35%. So on that basis, you have got quite a bit of a shift again if you go over. So the two areas that I see people tend to stick at is either they go for around the 50,000 to maximise the basic rate tax band, or they go up to the 100,000 so that they get up to the higher rates of tax, but they're not losing their personal allowance. So this very much comes down to a personal choice, if you've got a choice of what dividends you take. And it also comes down to what disposable income you need as a individual or as a couple, and some family planning of what money you need into your household. Obviously, you just definitely need to make sure you take account of the tax, because you need to pay that tax bill. And with all the penalties that are coming in, with late payments, with daily penalties if you get to that point, it can be very expensive if you're not paying your tax bill. So what I tend to recommend is that you do either put some money on one side, or you restrict what you take out of your company so your company can pay your tax bill, but in total you are not taking more than your gross dividend amount that you are allowed to take, including the tax that is payable. So there is a few ways to do it, but you just need to be abreast of what is happening with your tax position so that you know where you're at. What are you going to have to be paying in January? What are you going to have to be paying in July? So you can fit that cash flow into your household budget, into your business budget, however it fits with how you are running your business.
As you can see, the tax has gone up. Hopefully not too significantly, as we are only 2%, but it is just something to be aware of, because our net figure that you are taking home is going to be reduced rather than increased if you aren't looking at potentially increasing your overall income slightly. It may be you are pushing into a little bit of higher rate tax to make sure that that net figure is going to be the same as it was before, as if you're anything like me, you still need that income even if the tax goes up slightly, as well as the fact that inflation is increasing all our costs at the moment, from fuel to food to children's activities. So just be aware so that you don't get any surprises in the future, and obviously get those tax returns done early next year, which then means you can know exactly what you're working with to ensure that you have got the funds to be paying any tax bills to avoid any late payments. Hopefully today you've got an idea of when you should be taking your dividends and how much tax you will be paying when you do take them. If you have any questions, then please do leave a comment. Please like the video and do subscribe to the channel, and let's make tax less taxing.